Thank you very much, Judith. Ladies and gentlemen, attracting international investors, how can the EU work with its partners? The starting point of our study was the assessment that the EU has made very good progress since the financial crisis, stabilizing the monetary union, also launching the banking union, but that overall growth in the EU and particularly in the monetary union remains subdued. One of the key weaknesses remains a lack of investment. Global surveys of Europe's attractiveness show that Europe is still relatively attractive, but over the last couple of years, when we look at various indicators of attractiveness, the World Competitiveness Index, the various indices by the World Bank, Ease of Doing Business, Transparency International, Ernst & Young, and others, we see that Europe has fallen behind somewhat over the last couple of years. So one of the key conclusions is that Europe needs to pursue its multi-pronged competitiveness agenda with full force. Now, more specifically, Europe is a low-growth area. Weak investment is at the heart of the weak growth, and that is not just from a cyclical perspective, the business cycle momentum more in the short term, but it's also a structural, a more longer-term phenomenon. And therefore, strengthening investment would be very important for both lifting the cyclical momentum, but also lifting the longer-term forces of growth. The potential output growth rate of Europe is just 1%. That's not good enough. That needs to be increased. And one of the keys for this is to lift the rate of investment. I've already mentioned the surveys of attractiveness. I think a lot of work in Europe is underway. The structural reform agenda that is underway, the Juncker plan, and also the Capital Markets Union, but a lot more needs to happen going forward. So the approach that we take with our study this year is to examine how international investors can support the growth and jobs agenda of the European Union and support the Capital Markets Union at the same time. For this purpose, we have conducted 3 case studies, real-life studies, that analyze the need of 3 types of investors going forward. First of all, corporates, secondly, institutional investors, and thirdly, private investors. Now, our first case study looks at how to boost private equity and mobilize investment from private investors. The second study looks at how to attract international institutional investors, particularly into infrastructure projects. And the third case study is a survey amongst Swiss SMEs who are interested in investing in the European Union. Now, all of these studies show that there remain important obstacles to investment in the European Union. And based on this, we've put forward some case-specific recommendations to boost investment in the future, and also how to shape the policy dialogue going forward. Now, briefly on the first case study. Here we looked at ways to attract more investment from international private investors. One of the focus we have taken here is to look at the private equity markets. Private equity is particularly interesting, we believe, from an investment perspective. Private equity is a source quite often of long-term funding and funding for SME projects that otherwise struggle quite often to attract traditional forms of investment. However, what we see is that private equity in Europe is actually quite limited. In Europe, the private equity markets are only around 640 billion, compared with more than 2,000 billion in the US. Looking at the challenges, at the problem, why this is, why European private equity markets are so underdeveloped, we identify the restrictive regulatory regime, unfavorable tax legislation, also fairly high hurdles for the registration of investment vehicles, and cumbersome administrative procedures and red tape. What does that mean? Our recommendation for the reform of a private equity framework would be, first of all, to review the retail client classification in MiFID. It's too narrow, it's too restrictive, it restricts the investment opportunity of more sophisticated investors. Secondly, to target adjustments to the tax system. Thirdly, to bring about a harmonized interpretation of the AIFMD passport across the EU, and also to make a pan-European marketing passport available to investors from outside the EU. One additional point we would make is to consider seriously to mobilize the funds, the savings of ultra-high net worth individuals a lot more actively in the future than in the past. Globally, ultra-high net worth individuals account for a very large share of the global pool of savings, so that could be incredibly important to boost investment in Europe. And quite often, ultra-high net worth individuals have a particularly interest in diversification, but they're also quite open to long-term investments, which is particularly needed in Europe. With that, I come to the second case study, which is about attracting international private investors, international institutional investors, particularly into large infrastructure projects. Now here, we believe what is absolutely crucial is to develop novel ways of funding. We look at two specific cases here. First, the Thames Tideway Tunnel. It's a very large project. It has had a very long planning horizon, and that has made it quite difficult to assess through traditional private-public partnerships. Nevertheless, the Thames Tideway Tunnel managed to create a structure, a funding structure, where public and private money were combined. The way this happened was that the risk to private investors was limited to the industry standard of smaller infrastructure projects. So that was absolutely crucial. The second example we bring in is the Channel Tunnel, also known as High Speed 1 or Eurostar. Here what happened was that the government provided support and risk control in the initial period, but then monetized the investment. And this was done via a 30-year concession to two Canadian pension funds. Also an interesting example of novel ways of funding. Now, what are the lessons learned? First of all, we think that we need to think about efficient ways of risk sharing in the future. Secondly, we need to promote standardization across Europe. Thirdly, enhance comparability and transparency of projects. Well, very important, information, in other words. Then we need to address the regulatory and legislative burdens that are still present in many of these projects. We need to perhaps think about creating public competence centers. And last but not least, we need to create a transparent and reliable framework for dispute resolution in